Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Laurie Calvasina of RBC saying this: for a material move higher in the market by year end to be justified on the math, we think investors will need to start focusing on the outlook for 25, where visibility still seems a bit limited. Laurie's with us here in New York. Laurie, good morning to you.
Thanks for having me.
Let's talk about 2025. I think it's so difficult to do without really knowing what happens in November. How hard is it to answer that question?
Well, I think that's a great point. And that's the exact point a client I spoke with last week made. And it's interesting because on the one hand, I have equity investors, US-based ones at least, saying, oh, you know, there's not a lot to do on the election. We're not putting on any trades. And it's like, well, but visibility is limited. And, you know, what happens in November really matters. So which one is it? I think sort of a lack of clarity about what to do is also contributing to the fog.
You had a line that we repeated over and over again on this program for the last several months. You said that talking about the election with clients was like staring at the sun. Is it still like staring at the sun?
It's shifted a little bit, and you know, my joke's not funny anymore post-eclipse, but the reality is now I'm using the line safety in numbers, because what I'm sensing from the U.S., again, the U.S.-based people, not the people based outside of the U.S., but the U.S.-based people, they still don't really want to talk about the election all that much. And again, I've heard some very impassioned defenses of, I traded this in 2016, I traded this in 2020, I'm not trading this again, kind of coming out of the hedge fund community. The long onlys are like, yeah, I'll believe it when I see it. But the long onlys, what I'm hearing from them is that they're getting questions from their clients, primarily based in Europe and Canada and Asia and other places outside the US. So they're having to come up with talking points, and they're having to dust off the historical playbooks and come up with something to say, frankly. I don't think there is a lot of conviction from investors, and again, US-based ones, on which way the outcome is going to be, but there is a general sense that Congress is going to be divided and that you're going to have a split government generally, so not much is going to get done down the road. But that's really where people are right now. So we joke safety in numbers. Let's talk about the charts. Let's talk about the data, and we'll keep you all out of fights.
Well, isn't that conviction itself that there's going to be gridlock in Washington?
I think so. And look, that is my base case as well. But what I've told people is if you kind of, again, separate the two investor bases, and if you talk to people who don't sit in the U.S., they've generally been leaning into the Republican sweep idea for quite some time. So, you know, it's always a question, right? What are investors expecting? What's priced in? Different parts of the market are pricing in different things, I think, but I don't think anybody's pricing in the Democratic sweep. And even though that's not high on my radar either, I have been telling people you got to think about it a little bit, just because no one is.
Okay, so what if you do think about it and you do say to yourself, okay, this is how I would position for blue sweep versus red sweep? What's the number one trade for each? So
I think, you know, I heard one comment from a non-U.S. investor, you know, when we were talking about this concept of divided government, and they said, oh, I guess no more fiscal stimulus. So I thought that was interesting. It was a very, you know, kind of kind, innocent little comment. But I thought that was really, you know, just sort of interesting, because there's been so much consternation about, you know, well, this market shouldn't be this high, you know, gosh darn that fiscal stimulus. And, you know, sort of taking that idea out from, you know, kind of the market backdrop, I think is puzzling, you know, to some investors. To be honest, though, Anne-Marie, we did a survey, you know, back in kind of early to mid-April, where we actually asked our investors, what would you buy, what would you sell, what's your outlook for different industries under these different scenarios? And the Democratic sweep scenario, I think we only had like 17% of our analysts were bearish. Fewer than that were bullish. Most were in the neutral camp. Generally, it's the healthcare sectors and the energy sectors that come up as bullish or bearish under different outcomes. If you talk to my healthcare analysts, they're going to downplay the impact and tell you they're not really expecting too much out of either candidate, depending on who wins. And with energy, I do frankly wonder if people are just looking back at 2020 and don't realize that Biden's running a very different campaign than he was back then.
You said it's a kind, innocent comment to think that there's going to be no fiscal stimulus with divided government. Are you basically saying there is going to be fiscal stimulus, additional additional rounds regardless of who wins?
You know, I don't know, but I will tell you that when I look at Trump and Biden and I look at the different issues, and, you know, we kind of went through the Trump campaign website pretty closely. I know there's a lot of other stuff out there, but, you know, it's sort of a struggle in our seat, frankly, to figure out what to focus on and what's noise and what's real. But when I kind of go through, you know, kind of cut through the rhetoric and go through the policy ideas of the two different camps, it seems like they're both, you know, talking about wanting to keep jobs in the U.S. There's a big commitment to reshoring. I talk to investors. They think both these candidates are inflationary in terms of their views on trade and immigration. So I will say I think also U.S.-based investors, again, are struggling to come up with the salient differences from an investment perspective between the two candidates.
At this point, then, why are you just neutral? Why are you feeling not that great about stocks, given the fact that probably either candidate is going to try to stimulate the economy after they win, regardless of which party?
Well, again, we go back to our base case in Politics 101. And, you know, my Politics 101 class, Larry Sabato used to always tell us all politics is local, but he also reminded us how bills get created. And that's what I find I educate a lot of investors about. It doesn't matter what these two candidates say, right? You've actually got to have cooperation from both chambers of Congress to get anything done. And as you look at the landscape, do you really see, unless you have a united government, anybody cooperating with anybody in the next 4 years? Me, not so much. So, you know, that frankly, I think informs our view and a lot of investors' views. Like, on the one hand, does it really matter? Is anything actually going to be able to get done?
We're looking out to November because there's very little happening over the next week or so.
Yeah.
What we saw happen last week, and I think we should go over it, we saw a lot of people put a lot of weight on what most people would consider to be second-tier economic data, which is an S&P Global PMI in America, surprising to the upside, ignoring NVIDIA. NVIDIA was up on the week by 15%.
Yeah.
The S&P 500 dead flat. What was that about?
So I don't know so much about that particular data point, but if I rewind a couple weeks ago, I was out on the road and people were freaking out about the employment cost index, and I didn't even really even remember that that was a thing. And then the next week, investors were making fun of the people who were freaking out about that the prior week.
Sure.
So I think it all goes back to, if you look at 2025 again, and we want to be forward-looking, there's a lot of fog out there. There's a lot of clouds, not necessarily storm clouds, but just lack of visibility. And we're all just stuck talking about the Fed. I joked with a friend of mine recently that, you know, in equity land, we've all had to become rate strategists and, you know, kind of make friends with the economists. And so any little breadcrumb of information that can shed light on the will they, won't they, when they, you know, when are they going to go, that's all people seem to care about right now. And I think investing has changed over the years. We all get access to information, you know, whether it's the terminal or these other data sources. We can analyze things much, much faster. That accelerated during COVID. So people are looking for any incremental piece of data that's not widely watched to get some sort of clue on this debate.
Do you think we are just as sensitive to upside surprises as we are downside surprises? And with that in mind, what do you advocate for in equities at the moment?
So in my mind, the rotation thesis still makes a lot of sense. And I actually can see that being consistent with a sideways market. If you think about the rate of upward revisions as a good gauge for earnings sentiment, it's actually shifted back in favor of the top 10 market cap names in the S&P 500. But throughout most of this reporting season, most of the upward revisions were coming for the other 490 stocks in the S&P. So I think, you know, we've seen a little bit of bumps in that, but generally that mega cap growth trade is still quite expensive. It's still quite crowded, and it's got decelerating earnings growth, and that always makes growth investors nervous. Now, the rotation thesis, I think, is not just about valuation, but it's also about the economic tailwinds that have been building. And if you look at 2024 GDP, it's kind of stalled out around 2.4%. That's right at average. We haven't seen any movement to the 2025 numbers yet, which are still sitting around 1.7. That is weak GDP, and that's why I feel a little bit stuck right now, because to really get excited on 2025, I need to see that number go up, and it's not. And it's not really going down either. It's not doing anything. Now, the downside, I think your question is brilliant, you know, sort of the tail risks on both sides. What could drive us down? I think we're pretty fairly priced for a Fed that, you know, kind of maybe cuts once, moderating inflation, maybe a little stickier than we initially thought. But if we start to really see inflation expectations deteriorate, you know, in terms of moving up, if we start to see the Fed narrative fall apart again, there's a little bit of downside risk to this market, and I think that's underappreciated.
Flying blind into 25 is becoming a little bit of a theme. Laurie Calvasina there of RBC. Joining Joining us now, Pooja Sriram of Barclays and Deborah Cunningham of Federated Hermes for a conversation about the Federal Reserve. Pooja, I want to start with you. You've talked about the healthy scepticism you have about the degree of restrictiveness this Federal Reserve has with this policy rate, with this economy. Where do you stand on that now?
Hi, thanks for having me on the show. Yes, we've had our doubts about if policy is restrictive enough. And I think, one thing that keeps fueling that doubt is just given how resilient the macroeconomic backdrop remains. We saw, pretty firm data on spending in Q1. And honestly, our take on the retail sales, the latest retail sales print is really that maybe demand just normalized after a very big March increase. And there's, the fundamentals for the U.S. consumer still looks pretty firm. And I think, we echo what we learned from the minutes, that there is some uncertainty regarding the restrictiveness of monetary policy.
Deborah, how skeptical are you?
I'm probably not quite that skeptical. I do believe that even in an environment where inflation remains at 3 to 4%, 5.25 to 5.5, with the yield curve fairly flat, inverted to some degree as you go further out the curve, where expectations are different from a time frame standpoint. But I do believe, given where we are from a standpoint of growth in the economy, where we are from inflationary levels having come down as far as they are, but still with a ways to go, that the level that is currently being dictated in the market at 5+%, for the money markets, 5- small amounts for the bond markets, seems to be doing its job. And I feel like the Fed rhetoric that we have been hearing for pretty much from everyone since the last meeting has been that it's high enough. It doesn't need to go higher at this point. So I feel like we're going to don't fight the Fed type of trade at this point.
That said, Deborah, do you think it would be a mistake to cut rates here, given the fact that so many people are seeing enough momentum in the economy to really risk the potential for reacceleration in inflation?
I do. I think we're not to the time period that we need to see inflation or cuts due to inflation yet at this point. We have seen some, maybe cracks in some of the data, barring some of the second tier data that Mike was talking about earlier and that you were all speaking about. I think, when you look at some of the employment statistics, if you look at, the JOLTS data, maybe some of the broader indices from an inflationary perspective, it certainly is not what I would call a crack that turns into, a big fish or canyon. It's just something that I think probably takes the growth side of the equation down a little bit, more dependent upon the consumer, more dependent upon services than goods. And all of that plays into, sort of keeping rates where they are. I don't think the Fed is at this point in any need, nor are they being compelled to move rates in either direction.
Pooja, what's your take on this? Tom Tsouras of Strategas was on earlier, and he was saying that it would be a policy error for the Federal Reserve to cut this year, given the fact that there is so much momentum and a lot of in the pipeline inflationary pressure that's going to come through next year. Do you agree?
I think it really depends on how the data evolve here on. Our own baseline expectation is that perhaps they will find an opportunity to initiate a rate cut this year, most likely in September, equally likely in December, just depending on, how the data, particularly the inflation prints, play out. And if we indeed, get a series of 0.2% month-over-month on core PCE, and, that evidence accumulates, I think it'll be very hard for there would be no reason why they remain on hold. I think they can, get their foot in and at least get one rate cut. From a risk management perspective, policy would still be relatively restrictive in that world, but that would be a nod to the fact that the disinflationary progress has started.
Pooja, I think this is the struggle we always have. We all know it's about the economic data, but what economic data? Do you ignore the solid jobless claims? Do you maybe put some emphasis on the slowdown in retail sales? Do you put some weight on the PMI from last week of all things? Where do you place the most emphasis right now on the incoming information, and what do you choose to discount, to ignore?
Well, I think at this point we can't choose to discount or ignore anything. We know that, the Fed is highly data dependent, and the data is really our only guide to give us a sense of, how restrictive monetary policy is and how the conditions are to support the disinflation process. But, just in terms of what we're really looking at, it's the inflation outcomes themselves, which I think are top of the line, very important at this point in time. And I think after that comes the labor market data and, prints related to consumer spending. So be it retail sales or the real personal spending estimates like we get this Friday. I think those are the hard data that, we're really looking for, keeping an eye out. And then again, it seems like every little data point is important. And as you rightly pointed out, the markets reacted to the S&P Global last week. So I think at this point in time, we can't afford to discount anything.
Deborah, what's your take on this, given the fact that it seems like literally one comment in the beige book, potentially, that we are not aware of, could move things if it is something that confirms a sneaking suspicion or fear in the market?
I agree that it's a mosaic. It's hard to discount anything at this point. So taking in as much information as what you're being given and trying to digest it and put it into some, mosaic form that you can, theorize based on what your expectations are off of that collection of information, and with the intention that hopefully that has something to do with, what the Fed's intentions are. I think, the slowdown in labor market quits, maybe the ratio of open positions to those available to be hired. Certainly the retail sales. I mean, the consumer really has been driving this economy. So really anything that has to do with the consumer in specific, but also from a broader mosaic standpoint, you can't ignore global. You can't ignore, the non-consumer aspect of the market either. It all forms, sort of the theory that you're trying to come up with, which is higher for longer. I still think, too, when we're talking about rate cuts this year, we're only in May. Now, granted, we're at the end of May. We're almost at the beginning of summer. But there's a lot of this year to go, more than half of it. So I think many, many things can happen. And what the Fed is still trying to do is gain confidence. And I think that takes them somewhere in the neighborhood of probably 2 to 5 months. And that still puts us in 2024. End of 2024, but we're there.
End of 2024. But Deborah, to Lisa's point earlier, a lot of guests have come on this program and talking about all the inflationary pressures potentially in 2025. Is the Fed potentially, how do you think they think about 2025 when they think about inflation, and when some people are saying that they mean to hike after they cut at the end of this year?
I think that's overthinking it at this point. I believe that, their goal is to take what's available for them now. And yes, they do give 1, 2, 3 year types of forecasts in their, series of economic projections. But in fact, I think they're really focused on what they need to do now. And to the extent that that has some impact on the next year, the next 2 years, they'll deal with that at that particular point in time. So I really think they're focusing on what happens the rest of this year. And then 2025, maybe energy prices stop being the deflationary trend they've been. Maybe housing stops being the inflationary trend that it's been. Maybe there are offsets that are different, but I think, again, that's something that they will address as it happens, not as it's, sort of forecast in the next year, but rather in the next 6 months or so.
Pooja, we're in the business of overthinking things, so let's go there. Sorry, but it is the key thing that a lot of people are trying to game out, how much we do see in November, either policy shift from either candidate actually turbocharging any kind of inflationary pressure that's in the pike. How are you gaming out how this kind of percolates, whether it's immigration changes or tariff changes that actually end up being inflationary this year?
So I think in terms of being inflationary this year, I don't think those policy changes are likely to have an immediate effect. In terms of tariffs, we've done some work in the past when we had the previous round of tariffs imposed. It takes time for these prices to filter through to the economy. So if there is a policy change in that direction, sure, it will be an added impulse to inflation, but it's unlikely to be something that we feel in 2024. more. And of course, I think the second step to that thinking is, the scale of the policy. How many goods are we talking about? What's the share of all of that in our import basket? And even then, the share of imports in the CPI or the PCE basket is fairly limited. So direct effects are limited, and it'll take time for the second round effects to play out.
Hey, Pooja, thank you. We've got to leave it there. And to Deborah as well. To the both of you, thank you very much. An 18th NBA title is in sight for the Boston Celtics, the team advancing to their second NBA Finals in the past 3 years after completing a series sweep of the Indiana Pacers in the Eastern Conference Finals. An NBA title would cap a successful season for co-owner Steve Pagliuca, who just last week saw his Italian football side, Atalanta, win the Europa League. Steve, it's wonderful to catch up with you, sir. We've been talking offline, I know. I was so happy for you. Congratulations to you and the team. I want to begin with Atalanta. And I want to go through what this means to you. They are the underdogs of Bergamo, overshadowed by their glamorous counterparts of Inter and Milan out of Milan. How important was that for you, for that side, for the history of that club?
Well, I think it was huge. The Atalanta has not won the Europa Cup in 100 years, and the city of Bergamo is just ecstatic right now. When the team came back from the game, there's a nice shot of the fans in the stands. There was 10,000 folks from Bergamo there, and when they came back, they couldn't even get out of the airport. It was mobbed, and then they took a bus to the practice facility, and that was also mobbed at the field. And so they're feeling great. There's Carnesecchi, our goalie, with the medal, and it was just a wonderful time. That's a big cup, by the way. The two NBA championships would fit inside that cup.
Steve, your approach to this club and the way this business has been run should be a case study in a lot of schools. I just want to go through some of that so our audience really understands the background here. You've taken a chance on a lot of players that some clubs have left behind, including my own club, Milan, in the likes of CDK. You picked up Scamacca, Lookman too. You've identified talent, the likes of Coop Miners. This hasn't happened once. It's not happened twice. It's happened repeatedly. It's not an accident, Steve. Where does that come from?
I got a lot of credit to Luca Percassi and the Italian team we have on the field there. They've done a fantastic job evaluating talent, and really the mainstay of Atalanta is their academy. They've invested heavily in the academy in the last 15 years, and that's paid a lot of dividends. Calvini's a 21-year-old defenseman that starts, the youngest one in the entire Serie A, and several others like that. And then I think really taking players and putting them into a team-oriented system like the Celtics and having them pass the ball and putting them in the right spot. So the coaching staff, Luca Percassi, the whole organization gets credit for that. And, it's been wonderful to watch. It also helped that we took a risk on Rasmus Højlund 2 years ago. And he's a very young player. I met him in Sturm Graz, Austria, team that he played for, and he was 18. And we paid, I think, a record sum for one of the record sums for an 18-year-old at that time, $20 million. And Manchester United came knocking the door after the season, or we hated to lose them, but they paid $85 million. Then we invested in Scamacca and several other players to improve the squad. And it's been a magical season.
Steve, could we talk a little bit about that as well, the difference between Atalanta and the Celtics? When you have a star like Højlund and you get Manchester United coming in with massive money, how difficult it is to retain that talent at a club like Atalanta, and whether that is still the future. Is that inevitable, whether you're going to have to sell some of these stars again to continuously reinvent yourself, reinvent the club going forward?
It's really not that different than the NBA. Is when you win a championship, everybody wants your players. And so we think we can continue to prosper at Atalanta with a mix of young players and a mix of players that are sold because they have great opportunities. I think we'll change that a bit. We're playing European football. Before that win, we qualified for the Champions League, and that win gives you a slot in the Champions League as well. So that's going to be really helpful in our recruitment of players to improve the team further.
Steve, to really put you on the spot, has it been harder to run a football club or a basketball team?
They both have similar challenges. It's all about getting and retaining top talent and keeping them motivated and trying to do everything that you can to make their lives easy so that they go out on the pitch or go out on the court and play hard. And we try to do that in both organizations. It's very similar. Atalanta is kind of the can-do team with a great culture in Italy. It's the favorite team of many in Brabant, northern Milan, but also is a favorite. It's probably everybody's second favorite team in Italy. I just came back from Rome, and when we went in a hotel room, my wife and I found a large cake with an Atalanta symbol on it. So it's definitely Atalanta fever in Italy right now.
Steve, you are living pretty much everybody's dream, so congratulations for winning life. You have definitely done it. There is this idea, especially as you have two really successful teams, Celtics, heading to their NBA Finals, the second Finals appearance in 3 seasons. How do you monetize this? And I know that that's not the reason why you do this. You're in this for the love of the sport and all the passion. Is it going direct to the distributors? Do you find it actually more compelling right now because you have the actual intellectual property in a way that has changed with new technological advancements?
Absolutely. When we purchased the Celtics back in 2003, there was no Facebook or minimal social media, almost nothing. Maybe email was the technology of the day. Now what we have is fans were counted back then in the hundreds of thousands. Now they're counted in the millions and even possibly 500 million, a billion for global soccer teams. And also the NBA, which is prospering in Europe and China and all over the world. So the landscape's really changed. These teams have become, teams of the world, and the Boston Celtics certainly have that reputation. It's in terms of monetization, it's just a virtuous circle. If you get more popular, you get great players. You get more great players. You get more fans, and it's a great place to be right now with being in the finals a couple years in a row.
On that point, though, Steve, when you get a trophy, where does it immediately start to translate into money? Is it immediately in merchandise, ticket sales?
The main area quickly translates into a sponsorship. So for the Celtics, just the building of the brand and having a championship team, gets us more sponsorship income. When we bought the club, the sponsorship income was de minimis, and now it's in the tens of millions and approaching hundreds of millions. Brands want to be associated with a brand like the Celtics and Atalanta as well. Getting in the Champions League gets Atalanta more eyeballs. So having that championship culture and the brand and the reputation, that's what does it for the long term and creates value in the short term.
You went through what makes Atalanta so special and how you've really transformed that team. What about the Celtics? They're always winning. Why are they so good?
Well, that's one of the better questions I've ever had, I guess. I think they're good because we've had an incredible management team led by Whit Grossbeck for 20 years now. Rich Gotham, our president, it started out with Danny Ainge and now Brad Stevens in the basketball operation, a great coach. They all work together as a team and have been very smart in player trading and acquisitions. Same story in Atalanta. So it's all about trying to get the top talent on the field and doing, in both organizations, we believe in doing more work and exploring, using statistics, using scouts to see players 20 or 30 or 40 times, following players from when they're 8 years old into high school and college. And so that work ethic and kind of a will to win championships pervades each organization. And we've never been happier with those folks. And that's the great thing to see in both these situations. People were crying on the pitch at Atalanta after that victory. And last night in Indiana, which is a great basketball town, there was a huge celebration after that victory. And I'm just so happy for those players who worked so hard. It's just really hard to win championships. The NBA has had different champions the last 5 years. Same thing in Europe. It's just hard to get up every night and beat these great teams and overcome injuries. So I'm just pinching myself, and hopefully the dream will continue next week.
Steve, it sounded like you are a sabermetrics believer there for a second, so that seems to be part of what's going on. I will just say, right now, you must be on such a high. I probably haven't slept in a couple of weeks. There is this question of what's next in terms of, are you still interested in buying other teams? Is there still value out there? Or do you think that basically things have been bid up to such a degree, given all of the interest, that pretty much the opportunities aren't there anymore?
Well, when we bought the Celtics in 2003, the headline was venture capitalists pay record price for a team that was $360 million, and now the values are counted in the $4 billions. So that's been a question asked every single year. I think the fact that this technology has changed, that sports are now global, in the fight for eyeballs between the new media, such as Facebook Apple and old media, the networks, continues. And everyone wants properties that get eyeballs, and the properties that get eyeballs are sports properties. So I think there's still room to go up.
Steve, before we go, we've got to talk about a loss to the basketball world over the weekend. Bill Walton, we'd love a final word from you on his legacy.
Yeah, I was devastated last night. I'm so glad we won that game. I felt like Bill was looking down on it. I was very close to Bill in the 20-year run we had here, and his son Nate worked for us at the Celtics. And I just texted Bill 2 weeks ago. He sent me a nice. His son sent me a nice message about the winning the Europa Cup. He was watching that. He was an avid sports fan, an avid Celtics fan, and everywhere he went, he proselytized what a great experience it was to be a Celtic and be a champion. So the world and the NBA has had a major loss in Bill Russell, in Bill Walton, and 2 years before Bill Russell, two of the most iconic centers in the game. And we're going to really miss Bill, and hopefully our players will take extra heart into the games because of remembering Bill.
Steve, we appreciate you, sir. Let's catch up soon. Congratulations for all your hard work and success. Boston Celtics co-owner Steve Pagliuca.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.